Hey everybody, Brian Shannon from alphatrends.net. It's Friday, the 5th of February, 2016. Let's take a look at these markets. They got smashed once again and, get used to the script of failed rallies. We're in a bear market. The S&P 500 lost close to 3% this week, whereas the NASDAQ more than, almost 6% in here. The only green location is bonds, where they were up, bringing interest rates down further after the Federal Reserve raised interest rates. So their Federal Reserve is obviously behind the actual interest rate curve. Let's take a look at the action here on the chart. We'll start with the daily chart of the S&P 500. I've got a 10, 20, and 50-day moving average in here, and as I always say, the direction of the 50-day moving average, we want to look at the market with a declining 50-day moving average as guilty till proven innocent. And further, we also have a declining 10, 20, 30, 40 week moving average, being the 50, 100, 150, and 200-day moving averages. So we're in a stage 4 decline, and right now, obviously on this weekly chart, we're in an important area that has seen support right right around this level right here, and then obviously down a little bit further near 180. Where this market drops to is anyone's guess. I'm not going to try to pick a bottom, just like I'd never tried to pick the top of this market. Instead, wait for the evidence to tell us what to do. Don't listen to the analysts that upgrade stocks or the stock buybacks. If a stock's in a downtrend, those tricks work for only short-term little moves. You will end up losing bigger money down the road if you buy into that nonsense that occurs. So let's take a look at the 30-minute chart now, and we can see here. Let's just erase this stuff and start over again. This has been an important level of support. So we came down to that, obviously, here today with this further loss. And, what seems most likely to me is that we would get some kind of maybe a little bit of a relief rally for even a day or two. But then most likely this is, something of the trajectory for the S&P 500 seems most likely to me, at least. We did break back below and hold below that volume weighted average price from the January low. So now the average participants since that January low is losing money with that volume weighted average price up here near about 189 and a half-ish. So the volume weighted average price year to date also, of course, we remain below that. So let me just open this up a little bit so we can see that full year here, since the beginning of the year, that is, and put a VWAP tool on there, and you can see that we are still, of course, below that level. So, when we see the market rally above the 5-day moving average and above the year-to-date volume-weighted average price, there's nothing wrong with having long exposure, but being long is one thing. Staying long as it declines and breaks support is just foolish here. So, you've got to take partial profits off if you're looking to trade these bounces, and realize that we're going to continue to see a lot of gappy action. That's kind of the nature of the way that downtrending markets progress through time. Let's take a look real quick at oil as well. Here's a daily chart of oil, and oil closed the week out West Texas Intermediate at $30.98. Someone asked me today, do I think it's making a bottom and showing support? And I said no. I think it's still clearly in a downtrend. We see that this prior support right in here at 34 acted as resistance, just as this prior support acted as a resistance, just as this prior support acted as a resistance. We're still in a clear downtrend in oil. There's nothing here suggesting that the trend is changing, and not even really neutral. I mean, a little bit of consolidation here does not mean that the market that oil is making a bottom. Perhaps it is. We don't know, and there's no point in trying to guess. What we want to do is focus on the trends that matter most for our time frame, and regardless of what your time frame is, we're we're in a bear market, so take note, take action, be aware. The Nasdaq lost some important ground here, breaking below and holding below $100 here today. So let's take a look at the 30-minute time frame in there, and we can frame it with a volume weighted average price year to date, which we had briefly gotten above, and then promptly corrected that. Perhaps we'll test this level, or what we often see is a slight undercut of an important prior low, and that serves to get new short sellers in who are obviously late, because this market has just dropped basically from 104 and change down to 98, so it's dropped a little more than 6% here, 5% in the last couple weeks, and it broke the important support level. So now if it gets to below this next support level, what we often see, I was trying to make the point, was that we often see new short sellers who are late to the party get short in there. People who bought and put stops underneath this thinking it was the low will get stopped out, and that serves to take out the supply in the market. Meanwhile, the smarter shorts who are smart enough to short as the momentum turned back lower, as the market was below the volume weighted average price from the January low, it got stuck below that and the declining 5-day moving average, that they begin to cover their positions. And what we often see is that we undercut those lows slightly and then begin a rally. So, ideally Monday, maybe we even gap down, sell off a little bit, and then begin to reverse a little bit for a day or two. But still, the script it should be pretty much the same. Is that, I'm not calling for a rally up to this level, but it would make sense that if it rallies up towards here, that this prior band of support is likely to act as resistance and then turn lower. And the idea is that you want to sell short as it begins to turn lower, and then put your stop just above the most recent relevant lower high, which would be right here, at least from a swing trader's perspective, and then lower your stops and listen to the message of the market as it tells you when to get out. So clearly here on the weekly time frame, we are in this market obviously as well, since we broke below this level in a bear market. Don't listen to the nonsense that down 20% is a bear market. Look at your stocks. Look at the average holdings that you have in your portfolio. Look at the action of the leading stocks and what's happening with them. That is bearish action. Amazon, down from 700 to 500. That's a huge hit. Yeah, you can back it up and say, but what about this giant uptrend? It doesn't matter where you own the stock. If you own it at 425 and it's down to 502, you're still out, $200 from the high. You need a strategy based on market action of when to get out. As the pattern of higher highs and higher lows breaks, you want to be out of that action. Look at stocks like LinkedIn today, just got smashed in here, down 40 something percent, and then of course you had Facebook make new highs just this week, in fact, and gave back all those gains. Here's some important volume weighted average price levels I was showing subscribers to Alpha Trends, that we've got. You can look at this and say, well, it's at the 50-day moving average. Will that become support? Potentially, but when we look at the intraday action, we still see that there's this is still a downtrend. It's lower highs and lower lows below a declining 5-day moving average. Now's not the time to buy the stock unless you want to play guessing games. That's personally not the way I trade. And here's the 50% retracement of the January lows. We can put a volume weighted average price off that level as well, and you can see we broke that. Here's a volume weighted average price year to date. So this looks like an important level for Facebook to begin to stabilize, but we don't want to be a buyer until it starts to rally once again. There's no use again in playing guessing games. Let's go back to the Russell 2000, which has been the weaker market. Here on the weekly time frame, of course, we've seen that this market has gotten hit a lot harder. We had seen a little bit of a bounce up to this prior support area, and it got rejected there. So prior support, simple concepts, technical analysis 101. You don't need Adams pitchforks. You don't need a MACD. You don't need, all these other oscillators and indicators. Look at price action. Anyways, we broke down further here, obviously today on the 30-minute time frame, here we are with our year-to-date volume-weighted average price right there, and the volume-weighted average price from the January low as well. So, right now, perhaps we bounce a little bit from this level right in here, but if we do, I would expect that the most likely scenario is if we rally up towards that 100 level maybe, and then begin the next leg lower. That's the way trends evolve and the way they get played out. Now, the semiconductors came down to an important level here. This 4750 has been an important area of prior support and resistance, we can see, and we're still seeing choppy downward action. So perhaps in this market, we see this undercut bring in the late short sellers and hit stops out, and then begin a little bit of a recovery rally that maybe gets up towards this level. But then I would expect something like this. That's the way that markets trend. And the fact is that you want to be smart about how you get involved. If you're going to short it, you don't want to be the late short seller down here. You want to instead say, you know what, I missed that downward move. Where has it come from? It just came from 50 down to 47 and a half. Where does it have the potential to go before it's likely to find support? Well, this is that level. It's been support in the past. So maybe we undercut it and it slightly, but to short down there, the risk reward doesn't make sense. Would your stop go right here? That doesn't make sense to me. So I would rather see that it rallies up, and then as it begins to turn back lower again, then you want to be a short seller. You don't want to wait for this level. Let other people short down there or sell down there. Be earlier. This is where the momentum comes back in. Then set your stop just above the most recent relevant lower high. This isn't what I would expect that the market will play out something similar to this, but this is not meant as a blueprint. The biotechs tried to recover in here. They got above their 5-day moving average, and this looked like it had the potential actually of being a failed breakdown. So what earlier this week, it looked like we had a failed breakdown. It rallied back up, and it was trying to hold the 5-day moving average. Well, that theory got blown out of the water, obviously, this morning. As I told subscribers, what we were looking for was the possibility that if a bounce were to continue, that getting back above here might be a trade with a stop under here. Instead, obviously, there's no reason to buy as it's weak. We want to buy on strength, but only if we have a low risk place for the stop. That didn't materialize, and now the biotechs are continuing what they know best here in 2016, and that is to cause longs to lose a lot of money. They're in a downtrend. You might say, well, they're down too much or whatever. I had said, a few weeks ago that it seemed likely that this level, I think I set it up in here near 320 or so, that it seemed likely that sometime in 2016 we would be down towards 250. Instead, we're there now, just in the 5th week of trading in 2016. So you look at the 5-day moving average; it's declining. We're below a declining 5-day moving average. It's guilty till proven innocent. Expect it to fail. Apple is below all its key volume-weighted average price levels. The VWAP since the earnings report, the VWAP since the January 1st, that is, and it continues to be a terrible stock for long holders. It has been in a bear market. It continues to be in a bear market. And if you buy it because you think it's a good company, or if you buy it because you think this is support, I wish you the best of luck, but that's luck. It's not a strategy. Learn to approach the market with a strategy based on price action.